Hello everybody and welcome and good day to you. Thank you for joining me on this video. I was asked to present by a friend of mine an update on the LIBOR transition. So I thought, why not? Let's do that. It's a few minutes to get that update done. And I asked another friend of mine, close personal friend of mine, Dr. Periklis Thivaios, to prepare some slides for me because he is much closer to this topic than I am. He's a fellow faculty member on the BTRM. So it's his slides I'm talking to for this short video, updating the LIBOR transition. My thanks to him. And let's get started. Okay, so first of all, the big day has passed. There might have been any kind of Y2K expectations. Those of you of a certain age will know what that means. The end of 2021 with respect to the replacement of LIBOR passed almost as a non-event. Why? Mainly because it's been telegraphed well in advance. The large banks with the large legacy books have been preparing for this event for many years now, or some years now. Loan contracts primarily, only have to switch rates at the next reset date. Hence, the transition to the new rates doesn't constitute a kind of big bang, but an ongoing process. And principally in the US dollar market, of course, as I just said, there's another 18 months or so, just under, before we get to the extinction of US dollar LIBOR. And there's a number of alternatives for replacing that beyond just what the sanctioned regulator replacement was. Okay, so it's gone and it's come and gone, and there was no real great shakes about it, but there's one or two ongoing issues. So let's get up to speed on that. First of all, the concept or the issue of the credit adjustment spread. So a number of topics dominate the transition discourse, starting with the credit adjustment spread. The fixed ISDA trade association, ISDA CAS credit adjustment spread, is the preferred choice and the one supported by regulatory industry bodies. However, due to historically low interest rates, the ISDA credit adjustment spread is sometimes treated as the upper limit. And the debate has gone on for some time now. And in fact, an explicit disclosure of what that credit adjustment spread isn't always the case. In a transaction, many banks will simply embed that spread in their final product pricing. Larger clients sometimes wish for an explicit disclosure of that. So as the text says there on the bottom left on the slide, depending on who you are, there's a different conversation between the bank and the client when setting loan rates. As it says there in the middle, US dollar LIBOR fixings will continue until June next year. So legacy US dollar LIBOR transactions have another 18 odd months, just under, before fallbacks kick in. There are a number of loopholes about this. US banking regulators have forbidden new LIBOR-linked loans, but entities that are regulated by the SEC, like non-bank financials, can still originate new LIBOR loans. Although, as Periklis has just said there at the bottom, we're not quite sure why anyone would want to do that. But there are still some bits and pieces to tie up on that side of things. And then there's this issue of the tough legacy legislation that is also gridlocked in debate. Good word there, where LIBOR transition is not exactly a priority, and one can hardly blame them when one observes what's going on around the world. So there's still some issues to address on that, but in the main, moving across into the new replacement rate for LIBOR is what we're observing, and there is this issue of the credit adjustment spread now being embedded in most transactions and not explicitly referenced or explicitly identified. Now, despite the inflationary concerns and the tapering of asset purchase programs, interest rates remain at historic lows. That's quite right. And the credit adjustment spread, therefore, is, as I was just saying, something for ongoing debate. At current rates, low rates, we've just been historically low rates, benchmark switches from LIBOR to the RFR, the risk placement rate, together plus the ISDA fallback added on, may result in value transfers. That's a quaint way of putting it. Most sophisticated borrowers or larger borrowers or both push back against the use of ISDA CAS, as we've said, on the basis that it might be higher than they were expecting that move over, the transfer across, to be. Now, should one be using the ISDA credit adjustment spread, a spot credit adjustment spread at the time of the transaction, or a bespoke one? The ISDA/Bloomberg CAS and the Refinitiv US dollar cash fallback remain the most popular option for banks and customers to quote and use because they are transparent, they're fixed, which makes them transparent as well, and industry-wide, and one is able to align the loan pricing with the derivative fallback on using the same spread. So that's especially handy for hedged exposures. So that's the most popular option for banks and loan customers to use. Based on the scanning of various publicly disclosed transactions, A nascent CAS convention seems to be surfacing, at least for term SOFR-linked transactions. Now, SOFR, of course, is the replacement for US dollar LIBOR, the secured overnight financing rate or funding rate. And the publicly disclosed transactions convention seems to be settling on 10 basis points for 1 month term SOFR, 15 for 3 months, and 25 basis points for 6 months. And there's some examples of some transactions there that use the bespoke CAS convention that we've just quoted there. Okay, now on to some other things. Should one link to or quote or use the term replacement rate, RFR, the reference rate, or the in arrears rate, which of course SOFR and SONIA are? They are in arrears rates. Now there are term alternatives available, most clearly in the sterling market, in the UK market, where there are term SOFRs being quoted by more than one quote provider. By the way, ICE, the London Stock Exchange, there's more than one provider quoting term SOFR. Sorry, term SONIA, I should say, just to be absolutely clear, term SONIA. There is a term SOFR in the US. There is also in the Eurozone the reformed Euribor, which means one doesn't need to move on to the ESTER replacement for it. One can carry on quoting Euribor, 3-month Euribor, which to me makes a lot of sense, as it's an easy transition away from LIBOR. And also in Japan, there's TRF and TIBOR or TIBOR. But the use of term RFRs is explicitly restricted. That doesn't to me sound as harsh as it may look there on the screen. What that means is it's for customer transactions. So using a term SOFR to quote a loan rate and then using a term SOFR to hedge that loan rate is of course allowed, which is what the bottom text there in the middle column is saying. Term SOFR derivatives can only hedge end user exposures, i.e. if you make a loan referencing term SOFR, then of course the derivative can also reference term SOFR to hedge that. Now, what considerations should borrowers, lenders, and derivatives market participants bear in mind? First of all, is the use of term RFRs explicitly permitted as per the respective use cases? Can one's systems handle in arrears conventions? That's a key point as well. Can we properly risk manage the different rates? I don't think that is particularly insurmountable. And how will term rates behave vis-a-vis overnight RFRs in a rising interest rate environment? That's an ongoing conversation, actually. We'll have to see what happens with that, because we are currently, or shortly to be, around the world in a rising interest rate environment. Okay, so that's a handy whistle-stop tour on the update of where we are for these various LIBOR replacements. We've crossed the big milestone. We're not quite there yet. However, end of LIBOR is coming closer by the day. We still need to navigate that final stretch, particularly for legacy transactions. And on the other side of the coin, how exactly we treat new transactions. As I just mentioned, term RFRs are available in most currencies, and borrowers, corporate borrowers, would probably prefer their loan to be linked to that for the transparency and the explicit nature of it. Okay, I don't know about that last bit. Let's hope we don't have to experience yet another benchmark transition during our lifetime. Well, I don't know. It's been a bit of fun, hasn't it? Not. So perhaps we might. Let's see. Anyway, thank you for joining me on this quick update. No reference text, because, of course, this isn't in any of the textbooks previously published. So I'm going to leave you with that and see you at the next video. Thank you for joining me. Bye-bye.